There we go. Welcome, Zahra and Tim.
Thanks a lot.
Hi, Laurie. Thank you for having us.
Thank you, Zahra. So, Tim, let's try sharing your screen.
There we go.
There we go. It's just switching over now. Yep, perfect.
Okay, so hello everyone. It's early evening here in the UK. I gather it's morning in the States, and some other countries maybe afternoon and into the evening, but very nice to have you all on board. We're going to be talking about inheritance tax and will planning for connections in the UK. So this is all about if you have clients with any connections in the UK. The slideshow seems to want to be slow at moving.
Oh, it's not doing it.
Oh, there we go. All right.
Yeah.
There we go. Right. Okay. So inheritance tax in the UK is a tax which is based upon two different things. Now, these are UK concepts and they may be different and sound different in different countries, but the main concept is domicile, which I will explain in a moment. And the second question is the situs of the assets concerned. So let's go and have a look at domicile. So domicile, it isn't actually defined in UK tax law. It takes its meaning from general law. You are considered from a UK perspective to be domiciled in what you might consider your mother country. Where do you herald from? Where are your roots? And there is no defining issue that creates a person's domicile. It's a question of looking at several factors. And the normal suggestion I use when I'm talking to people about this, if you took a 1,000-piece jigsaw puzzle and you threw it up in the air and it landed on your desk, you'd have some that would have a picture on it, and there was some that would have the blank grey side on the back. And the picture side is for you, determining your domicile of the country you want to be in. And the grey side is for the taxman, determining a domicile where he wants you to be. And the object of the exercise when looking at the details of someone's history is to be able to flip grey jigsaw bits over to picture jigsaw bits. So there are four types of domicile. There's domicile of origin, domicile of dependence, domicile of choice, and deemed domicile. And we're going to quickly look at each of those. So domicile of origin, this is the domicile that you acquire at birth, being that of your father. This is very, very old English law, so apologies to the ladies out there, but it ignores ladies and it only looks at the gentleman. And it follows the hereditary line up from your father to your paternal grandfather, etc. It's only where parents are unmarried or divorced during someone's minority, which is under the age of 18, that you look at the domicile of the mother or the parent with whom the child lives, as the case may be. Domicile of dependence is during someone's minority, so whilst they're under 18, they have a domicile of dependence, which is depending on which parent they are living with, particularly where families have divorced and separated. They may be living with the mother, and therefore they will take the mother's domicile from that perspective. And for the period for which the person is under 18, it displaces their domicile of origin. Domicile of choice is you trying to change your domicile from either your domicile of origin or your domicile of dependency. Now, domicile of origin is extremely adhesive. And the normal way I describe this to people, if you look at contact adhesive, in the UK, we would use something like Yoo-hoo or one of those, or Bostik. And if you put some glue on both surfaces, you put the two surfaces together, when you pull them apart, there's a whole load of strings between the two surfaces. And in order to sever your domicile of origin, you've got to cut each one of those strings. So it's about changing all your ties to the original country that you were had a domicile of origin in, and replacing all those ties with ties in your new country. It's quite a process, and there are some very detailed questions that get asked by the UK tax authorities when people are trying to make such a claim. The last one is deemed domicile. Now, deemed domicile is a concept that was originally introduced many years ago purely for inheritance tax. And originally, it looked at whether you were UK tax resident for 17 out of the previous 20 years. So if you were talking about a gift, or if you were talking about when someone passed away, that would be your backstop. You would go back 20 years and you would look to see whether somebody had been UK tax resident for 17 years. That rule changed on the 6th of April 2017, and we've had many rule changes in that era, and it became 15 out of the last 20 as opposed to 17. So it happens a bit quicker now. So the deemed domicile changes, as I mentioned, it's moved from being 17 out of 20 years to only 15 out of 20 years. And the deeming now applies to all taxes, not just inheritance tax. So if you've acquired a deemed domicile in the UK, you would need to be outside the UK for a minimum of 6 complete UK tax years before you lost that deemed domicile. Now, why this is all important is because part, as I mentioned earlier, part of the mainstay of the inheritance tax charge relies on your domicile. So now we're going to move on and we're going to look at some exemptions and the rate of tax for inheritance tax. So in the UK, we have what are known as potentially exempt transfers. These are transfers that are made between humans, individuals, and they are initially exempt from inheritance tax. And if you survive making the gift by 7 years, then they will fall out of the charge to inheritance tax. We'll talk a bit more about that slightly later. There is a spousal exemption. Now, not all countries that have inheritance tax have a spousal exemption, but we do. There are certain exclusions to that, and again, I'll talk about that a bit more in a minute. Our annual exemption is quite a meagre one, to be honest. It's been set at this level for many, many, many years. It is only £3,000. But if you didn't use the exemption last year, you can combine it with the exemption for this year and double that up to £6,000. You cannot carry forward any more exemptions than that. There are exemptions for making gifts when people get married, and we'll talk about that again a bit later. A very underutilized type of relief is regular gifts out of income. I'll go into all of these a bit later on. Business property relief. So as an example, if someone owns a private company in the UK, then that currently is 100% exempt from inheritance tax. Agricultural property relief refers to farms and to farmhouses and things like that. The rate of tax is 40%. And we have something called a residence nil rate band, which was introduced not so long ago. This is where you transfer your home to some of your close relatives, so either your spouse or your children. And there's an additional amount that is exempt. Now that is up to a maximum of £175,000. We also have something called a transferable nil rate band. And in the UK, the nil rate band is set at 325,000. So if you combine that with the residence nil rate band, if you're entitled to it, you get a maximum taxed at zero rate of £500,000. You also need to consider when you're doing any inheritance tax planning or estate planning, what you can afford to give away and what you want to give away and when you want to give it away. So potentially exempt transfers, as I mentioned earlier, these are gifts between humans and there is no inheritance tax that is chargeable immediately, and there's none that is charged at all if the donor survives the gift by 7 years, completely falls out of account. However, what's absolutely important is that the gift is a totally no strings gift whatsoever, and that the person making the gift does not in any way, shape or form benefit from whatever they've gifted. Because if they do, then the inheritance tax clock, as we call it, the 7 years, does not start ticking until such time as they cease to benefit from the asset. We do have a sliding scale that applies to the amount of tax that's chargeable once 3 years has elapsed after the gift has been made. What's important, and it's a very common misconception and common error, the reduction that is given is not on the amount of the gift, it's on the amount of the potential tax. So I mentioned earlier that the nil rate band, the amount that's charged at 0%, is £325,000. So if somebody made a gift of £300,000, having not previously made any gifts, that would be taxed at 0%. And therefore, the discounting does not produce any reduction in tax at all until the 7th anniversary has happened. Spouse. Now, I mentioned earlier spouse exemption, and we come back to this domicile issue. So if both spouses are domiciled in the UK, there is a complete and total exemption of any gifts between those spouses whilst they are married. They can separate, but so long as they're not divorced, then they can still make gifts between them which are free from inheritance tax. The usual issue we find that causes interest is in the international aspect of life, where you will often have what we call mixed domicile marriages, where one person is domiciled in the UK and one person is domiciled outside the UK. Now, in those circumstances, the person who is domiciled in the UK, they are limited as to how much they can give to the spouse who's domiciled outside of the UK. And it's limited to a lifetime amount, and that's really important. It's a lifetime amount, it doesn't refresh, of £325,000. So if we go back to, I said earlier, we had the nil rate band of £325,000, and you've got the non-domiciled exemption of £325,000. And if they also qualified for the the residence nil rate band I mentioned, which is 175,000, you would have 650 plus the 175, you would have £825,000 as being the maximum amount that would be taxed at zero. Anything over that would be taxable. And with house prices in the UK being as high as they are, it's not difficult to exceed that limit. So it's very important, if there are mixed domicile marriages, that advice is taken at an early time. And it's not unusual that the only actual sensible answer is for the parties to take out insurance to cover themselves during the relevant period concerned. The annual exemption, as I said earlier, is £3,000, and you can carry forward from one year to the other. In addition to the annual exemption, we've also got a so-called small gifts exemption, which is for £250 per person to as many people as you like. Historically, this was really designed to deal with Christmas or birthday gifts rather than anything other than that. Marriage. Now, this depends on the relationship between the person making the gift and the person who's getting married. As you can see from the table there, if it's a parent, the exempt amount is £5,000. If it's anyone else, the exempt amount is £1,000. Regular gifts out of income. Now, regular gifts out of income, they are an extremely useful tool for reducing inheritance tax. It's very important, however, if you're going to try and make this claim, which you make at the time the person has passed away, that there is sufficient data available to enable the claim to be successfully made. Now, in the UK, when you file the inheritance tax return, it consists of several sections. The relevant section for here is the IHT 403, and the last page of the IHT 403 is reproduced in Appendix 2, and it shows you that you need to look at a 7-year window, and you're looking at the income from all sources, less the income tax that might be paid on those sources, and it's only income you look at, you don't look at capital. You then take off someone's living expenses to arrive at what is considered excess income. And to the extent gifts are made out of that excess income, you've qualified for the first half of this relief. However, for the relief to be successful, the gifts have to be considered regular. And it's not about making gifts regularly, generally, it's about making a gift to a specific person regularly. So if I wish to give money to my daughter, as an example, I would need to give it to her regularly. I couldn't give it to my younger daughter and definitely give it to my elder daughter, or even make a gift to Zahra separately or Laurie. It doesn't work. It has to be to the same person and on a regular basis. HMRC consider that if you don't pre-promise to make gifts, either by making what's called a deed of covenant or by writing a letter to the people you intend to make the gifts to and say, it's my intention to make regular gifts to you of either an exact sum or a percentage of excess income, HMRC want to see a pattern of at least 3 gifts. Now, the gifts could be weekly, they could be monthly, they could be annual, biannual, whatever, but they want to see a minimum of 3 gifts to the same person before those gifts will be considered to fall into this relief. Business property relief. So business property relief, as I mentioned earlier, is 100% relief available against the value of a trading business. Now, whether that's as a sole trader, as a partnership, as a limited liability partnership, or as a private limited company. However, the relief is reduced to 50% where assets are owned personally, that are used in a qualifying business, or where somebody has a controlling stake in a publicly listed company. In order to qualify for the relief in the first place, the assets need to have been owned for a minimum of 2 years. And that is important because you don't get any relief if it's before that. Sorry, I'm just trying to get rid of my emails because they're going to keep popping up. That's not going to go. Where assets qualify for business relief, ideally you should avoid them being left to your spouse because you will have wasted your business relief. Spouse is exempt in any event, unless it's a non-domiciled spouse, and you would be wasting the business relief by leaving gifts to spouse. What is commonly done is to leave the relevant gifts into a discretionary trust. The spouse may well be a beneficiary within that trust, but in that instance, it enables you to claim business relief, and then subsequently, those assets in that trust are not in the spouse's estate and therefore doesn't get caught when the spouse passes away either. Agricultural property relief, as I mentioned earlier, it's normally 100% on any agricultural property transfers, so farming land, farming buildings, etc. There's a really, really important elephant trap here, however. If you make a gift of business or agricultural assets to an individual, that gift will be a PET, potentially exempt transfer. And the PET rules override the business asset or the agricultural asset rules. And what is important here is that if the donor dies within 7 years of making the gift, you have a so-called failed PET, which we spoke about earlier. What's important is in order for you to get the business property relief or agricultural property relief, you have to, those assets have to qualify for business property relief or agricultural property relief, both at the time the gift was made and at the time someone died. So the classic issue here is that mum and dad are deciding to retire. They maybe gift the shares in their company to the children. And then within that 7-year window, the children sell the company on because somebody's made them a really good offer. And then unfortunately, after the sale, but before the 7 years, the parents pass away, or one of the parents passes away. And that gift that they originally made to the children of what was a business asset when they gave it is now cash in the hands of the child or shares in a non-qualifying company, and therefore business property relief will be denied and inheritance tax will be payable on the amount of that original gift. So it's a really important issue to look out for. And what you would normally consider doing is taking out insurance just for a 7-year period to cover that liability in case. But it's something you would discuss very thoroughly to decide whether there's any issues there. So the rate of tax, as I mentioned earlier, 325,000 at zero. That's known as the nil rate band. And the balance is always taxed at 40%. The residence nil rate band which came in 2017, is all about passing on the house that the person who's died lived in to either spouse or their children. If it's not to any of those, this particular relief does not apply. Now, in the circumstances where a spouse passes away and all the assets that that spouse has are transferred to the surviving spouse, when the surviving spouse passes away, it's possible to utilise the first spouse's nil rate band or their residence nil rate band. So if you add all those reliefs up, on the passing of the second spouse, there could be £1 million exempt from inheritance tax. Now, if when the first spouse dies, they don't transfer everything to the other spouse, then you have to work out as a percentage of the nil rate band how much was given to anyone other than the spouse. And in our example here, we've given £100,000 to someone other than the spouse. The nil rate band at the moment is 325,000. So 100,000 over 325,000 is 30.769%. Now, why that's done as a percentage is because should the nil rate band rise, and it hasn't risen for years, but should it rise, you look at the nil rate band in play at the point in time that the second spouse dies. And in my example here, I've shown the real nil rate band moving up from 325,000 to 400,000. And therefore, the amount of the nil rate band that can be transferred from the first spouse is 69.231% of 400,000, which is 276,924. So you might have thought that the amount that was transferred would be 225,000, being the original nil rate band, less the gift to people other than the spouse. But because it's done as a percentage, and in my example, the nil rate band has increased, you see that has gone up to 276,000. Consider what you can give away and what you want to give away. Now, when I talk to people about inheritance tax, I always say to them there are three pots. There's what I call the rump. That's what you're going to pay tax on. Sorry, but that's what you need. That's the last thing that's ever going to be given away, and you're very, very likely to pay tax on that. The next box is what you need today, depending on your circumstances. And the third box on the right-hand side is today, what you can give away. Now, during people's lives, depending on their needs, you will find that things move from the left-hand side to the right-hand side until such times they need care. And then when they're starting to need care, you'll find that assets and things will need to move the other way. So great care needs to be given when people are deciding what they want to give away and what they can afford to give away. And it's a good idea to try to allocate items into these boxes so that you have a plan as to what you can or can't give away. I'm now going to hand over to Zahra, who's going to take you through the legal side of things in terms of wills, lasting powers of attorney, and the probate process. So Zahra, over to you.
Great. Tim, do you want to stop sharing and then we'll get Zahra to share the screen? And while we're doing that, Tim, we just had a question again. What was the rump expense box again?
So the rump is the assets that you cannot give away. You just cannot afford to give them away. Classically, it would be your house. It would be a base set of assets that produce income that you need to live on.
Perfect. Thank you. Good. Looks like you're all set up, Zahra.
Yeah, all set up to go. Can you see my slides, Laurie?
Very good.
Brilliant. Thank you. So good morning, good afternoon, good evening to you all, depending on where in the world it is you're joining us from. And thank you, Tim, for taking us through giving us an overview of the UK inheritance tax system. I think it's really important that you've got that information first before I start talking about wills for UK domiciled clients, because I find it impossible to understand how people can write wills for individuals here in the UK without understanding what the inheritance tax position is. Wills, if not drafted properly, will not capture the allowances and the exemptions that Tim mentioned. So anyone that deals with the drafting of wills here in the UK has to be very familiar with the UK inheritance tax system to ensure that the documents that they put in place actually capture those allowances as much as possible. But also, again, to look at what Tim has said, to look at other planning strategies that may exist in lifetime in order to mitigate the inheritance tax position that may arise on death. And I think it's really worth noting that certainly Tim and I work together on several clients, but you have what we call the holy trinity of advisors. You've got your accountant, your lawyer, and your financial advisor. All three of them will be involved in bringing together a very comprehensive estate plan and to plan for future needs as well as to mitigate inheritance tax. So some of the things that I'm going to cover today, as Tim mentioned, the purpose of writing a will, a couple of different type of will structures that may exist, the validity of wills, challenges to wills, and also to look at a very brief look at the administration and the probate process here in the UK, which I understand is quite different to other jurisdictions. And then finally, to wrap up with something slightly different, but to look at what happens if you're alive but incapacitated. So the whole discussion on powers of attorney. So that, in a nutshell, is what I propose to cover over the next few minutes. So to start off with, why write a will? Here in the UK, we have a very basic concept, the concept of testamentary freedom, that there are no forced heirship rules here in the UK as may exist in other jurisdictions, particularly in continental Europe or in the Middle East. We have a principle here in the UK that in theory, subject to some very minor exclusions, you can leave your estate to whomsoever you want. So the purpose of the will is to control the distribution of your estate on your death, to give you a choice as to who to appoint as your executors. Now, if you were to die without a will in the UK, and I have a slide on this later on, the law would step in to dictate how your estate is distributed and who deals with it. So to override those statutory provisions, you actually want to have a will in place to make sure that your wishes are fulfilled. Thirdly, to minimize inheritance tax on death, as I said, if the wills are not drafted properly, some of these allowances that Tim mentioned won't be captured, and you could end up with a tax liability, even if you have a spouse, even if you do certain things. If the end document doesn't actually do what it's supposed to do from a tax point of view, you could actually end up triggering a liability instead of avoiding it. And lastly, for administrative convenience, it is much easier to go through the probate process here in the UK where there is a will in place, where there is clarity of intention in terms of distribution, as opposed to the situation where somebody passes away without a will. It's entirely possible to go through the administration process where there isn't a will. We deal with it all the time, but it just makes things a little bit easier if there is actually a valid will in place. So I just want to start off with by mentioning, what does your estate include? So what is it that your will is actually capable of covering? And what is it that is potentially taxed when somebody passes away? So the starting point is that everything in your possession, everything that you own at the time of your death is subject to inheritance tax and can form part of your will when you pass away. That includes cash, personal possessions, property, whether it's your main home or investment properties, investments that you may have, as well as assets that you hold outside of England and Wales where you are domiciled in the UK. As Tim mentioned, if an individual is domiciled in the UK at the point of their death, all of their worldwide estate, wherever it may be situated, is subject to UK tax, UK inheritance tax. There may very well be double tax treaties in place with the UK that mitigate and reduce that charge, but as a basic principle, if you're domiciled in the UK, as a first step, all of your assets from wherever they may be in the world come into the charge of inheritance tax. The following assets generally don't form part of your estate. What I mean by estate in this particular context is these particular assets are not capable of being dealt with by your will. In certain circumstances, they can still form part of your estate for inheritance tax, but they can't be covered by the will. So for example, assets that you hold jointly with another person, property, bank accounts that you hold with, say, a spouse by way of a joint tenancy, whereby if one of you was to pass away, the asset automatically passes to the other. That cannot be dealt with by a will. That happens independently through the principle of survivorship, as many of you will know. Tim also alluded to the fact that life insurance can be used as a method to fund the payment of inheritance tax going forward. So often people do take out these policies to make sure that there is a pot of money available in the event that they were to pass away. Some people may take it out for mortgage protection reasons, whatever it may be. Life insurance policies are normally recommended to be written in trust. And the reason for doing that is that the proceeds then fall outside of the estate. Those proceeds cannot then be included or dealt with by the will. They fall outside of the estate, both for succession and for inheritance tax purposes. So again, if somebody here in the UK does have a life insurance policy, our advice would always be to write that policy into trust to make sure that the proceeds pass to the beneficiaries outside of the estate and therefore free of inheritance tax. And at this point, I want to touch on the distinction here between joint tenancy and a tenancy in common in the particular context of property ownership. Here in the UK, we have two-tier ownership when we're looking at property. There's a distinction between the legal ownership and the beneficial ownership. The legal ownership is exactly what it says. These are the individuals that appear on the legal title at the UK Land Registry. These are the individuals that are capable of selling, charging, or otherwise disposing of or transferring the property. The legal title is always held as a joint tenancy, and you can have no more than 4 legal owners of a UK property. We then look at beneficial and equitable ownership, which is the underlying enjoyment. Who actually is it that's entitled to the property? You'll often find a situation where there is an individual named on the legal title, but they don't actually have enjoyment of the underlying asset. When you're looking at taxation of property, the revenue looks at who actually owns the underlying equitable interest, who owns the beneficial interest, who enjoys the benefit of that property. And that is the individual that falls within the charge to tax, not necessarily the legal owner. So under English law, the underlying equitable or beneficial ownership can either be held as a joint tenancy or a tenancy in common. With a joint tenancy, the principle of survivorship applies, and on the death of the deceased, their share automatically transfers across to the surviving owner with absolutely no formality. Outside of any will, it's an automatic transfer. A transfer by way of survivorship doesn't form part of the estate for succession, so it automatically passes to the surviving co-owner, but the value of that asset still forms part of the estate for inheritance tax purposes. Now, if your co-owner is a spouse and you pass away, it passes to them outside of the estate for succession. Its value still forms part of the estate for inheritance tax, but because they're a spouse, the exemption would apply, so there would be no tax to pay on that share passing to the spouse. We then come to the alternative form of ownership, which is a tenancy in common. This is the idea that each co-owner has a separate discrete interest in the property that on death doesn't pass automatically to the co-owner, but passes under the terms of their will or under the rules of intestacy if there is no will. And often in that situation, you will have what we call an underlying declaration of trust that sets out the shares of the co-owners. We see it often. For example, parents may give children a gift acquiring an interest in a property. You will have cohabitees, for example, that put in differing amounts into the purchase of a property. They will not necessarily want to hold their shares equally. There may be an unequal ownership proportionate to the amount that they've put in. A declaration of trust would be required to set out their shares so that when the property is sold in the future, there's no dispute and there is agreement about who receives what. In that situation, you would also potentially maybe look to build in a right of preemption. So if, for example, you had cohabitees that had put in differing amounts into a property and they held separate percentages in the underlying beneficial ownership, and if that relationship then breaks down in the future, one party might have the funds to buy out the other. So a declaration of trust is an agreement between the co-owners that caters for all of these things. In the absence of a declaration of trust, each co-owner is deemed to have an equal share in the property. So if there are 2 co-owners holding as tenants in common, in the absence of a declaration of trust, they're each deemed to have 50-50, which may not be what they want. So the declaration of trust is actually a very important document. Where you hold the property as a tenancy in common, you would normally have a restriction put on the legal title at the land registry. So this means, for example, you can end up with a situation where you have underlying beneficial owners that are different to the legal owners. It therefore means that the legal owners could deal with the property without the consent of the underlying beneficial owners. Having a restriction on the title puts a buyer on notice that there are other interests that need to be considered. And until those underlying owners or those underlying people that have an enjoyment of the property agree and consent to the sale or to the disposal of the property, the transfer can't go ahead. So the legal owners are restricted by that restriction that's on the title. And a share that is held as a tenancy in common forms part of the estate, so it passes under the terms of the will, as I mentioned, and its value also forms part of the estate for inheritance tax purposes. When couples, for example, or co-owners go to purchase a property, they are normally given advice by their conveyancer on the options available to them, the implications of holding as a joint tenancy and the implications of holding as a tenancy in common. If people don't make an active choice, the default position is that they will hold the property as a joint tenancy. Now, most married couples tend to hold property as a joint tenancy. So if one party passes away, the property automatically passes to the other. And the reason being is that they want to provide security for each other. There are, however, certain situations where married couples hold their properties as tenants in common for tax planning reasons, where you have blended families. You've got people that have remarried and have children from previous relationships. You have people that are looking to protect against care home fees, and I'll touch on these again in a bit more detail going forward. And again, as I mentioned previously, where each party contributes differing amounts to the purchase price, it may be more appropriate for the parties to hold as tenants in common to set out the actual extent of their shares and to have the underlying declaration of trust in place that governs their ownership of that property. There's a note here that I wanted to mention for divorcing spouses or civil partners. If you're holding a property as a joint tenancy with a spouse and you're getting divorced from them, it would be sensible to think about severing the joint tenancy, because if you were to die before your decree absolute was granted, under the principles of the joint tenancy, your share in the property would automatically pass to the spouse, and you obviously may not want that if you were divorcing. The idea would be to convert the ownership of the property into a tenancy in common, so your share of that property is then governed by your will, and to then either update or create a will that sets out where you want that share to pass. It's not it's not as easy as that. Usually when you go to sever a joint tenancy, you need the consent of both parties. It is in the interest of both parties to agree to that, but as we know, these things can be contentious. If you're a divorcing spouse and you hold a property as a tenancy in common, again, it would be sensible to think about updating or creating a will to ensure that your share of the property then passes to whoever you want it to go to, if that's not your divorcing spouse. There's a couple of will structures that I wanted to talk about, and this is one that we do very often. This is a will structure that is particularly appropriate for blended families, for people that remarry, having had children from a previous relationship, as well as those at a later stage in life that may wish to protect against care home fees. Now, there are several advantages in leaving your entire estate outright to your spouse. The main advantage is that it provides protection for your spouse. The administration of the estate is fairly straightforward. You claim your inheritance tax spouse exemption. The allowance of the deceased spouse simply transfers across to the estate of the surviving second spouse. The surviving spouse remains in control of the entire estate. And a lot of people like the simplicity that comes with that. So despite hearing about this particular option that I'm going to discuss, a lot of people still go for the outright to spouse option because of the simplicity that it brings. The disadvantage of that option, whereby you leave everything to your surviving spouse, is that you may go on to remarry or cohabit with another person. And that means that, and if you have children from a previous relationship, leaving everything outright to your new spouse could be dangerous, particularly if they have a dispute with your children after you pass away. If you leave everything to your spouse, they come into full legal ownership of the assets and can then potentially change their will. What happens if that spouse then becomes incapacitated? They've got a whole estate over which they have no control because they've lost capacity. And it also means that once a spouse comes into the entire ownership of the estate, if they have to go into care at some point in the future, the entire estate is available to pay for care going forward, meaning that the children and other beneficiaries could then potentially receive less, depending on the amount and the extent of care that may be required going forward. So whilst the simple option has its advantages, it also does come with its disadvantages. And part of the conversations that we have with clients focus on looking at the advantages, the pros and the cons, and then working out what actually is important to the client. For some, it is, as I said, simplicity, but for others, these other issues can be, a real concern. So one option to protect against, or to protect to a degree against these disadvantages, is to have a will structure that incorporates what we call a flexible life interest trust, or what we call a FLIT. So in this situation, we've got a husband and a wife, and I'm going to kill the husband off first. So on the husband's death, he leaves his entire estate on a FLIT, on a flexible life interest trust for his wife. Now, under the tax rules, the inheritance tax rules that exist in the UK, because the spouse is the beneficiary of this trust, the spouse exemption for inheritance tax is available, which means that even though the spouse is inheriting through a trust as opposed to outright, there is still no inheritance tax to pay at this stage, and the allowances transfer across from spouse number 1 to spouse number 2, as Tim mentioned. The surviving wife at this point in time has an entitlement to income, but no right to capital. So where we're looking at property, she has a right to occupy property. She has a right to receive the rental income from property, but she doesn't own the underlying capital of that share that's left behind by her spouse. However, we do build in a power for the trustees to pay capital to the wife should she need it. So for example, if she runs through her own resources in her lifetime and she needs more to pay for care, she needs more for medical expenses, she needs more just to fund her lifestyle, the trustees have a power to release capital from the FLIT to the wife and give it to her if she needs it. When the wife passes away, so many years later, let's say, the value of her estate is aggregated or added together with the assets that are still within the FLIT structure. Inheritance tax is charged if the value of the estate is above the allowances of the combined allowances of husband and wife, and the tax charge is apportioned accordingly between the trust and the free estate of the surviving spouse. So the aim here is that whilst the wife is alive, to reduce the amount of value that's sitting within this trust by making gifts from the trust to children, let's say. And the idea behind doing this is that when she finally passes away and the value of the FLIT is aggregated with the value of her free estate, we want to reduce down the value of that FLIT as much as possible so there's less to tax. The one sort of catch-all is that when assets are released from the FLIT to the children or other beneficiaries that are named in the trust, the wife has got to survive the 7-year period. This transfer of value from the FLIT to the beneficiaries is treated as a PET, a potentially exempt transfer, which Tim mentioned previously, for which the wife has to survive a full 7 years. If she doesn't survive 7 years, the value of what's been taken out of the trust is pulled back in and taxed accordingly when she dies. If she doesn't survive the full 7 years, but survives at least 3, the taper relief or the sliding scale that Tim talked about and that's replicated in Appendix 1 is what is used to determine the charge to tax on that transfer. In order for the FLIT to work properly, the property has to be held by the spouses as tenants in common. So the husband's share of the property passes into the FLIT under the terms of his will, as opposed to going outright to the wife under a joint tenancy. So this is one very common situation in where you will find spouses holding properties as tenants in common, as opposed to joint tenancy. Now, this structure works very well for the right client. It's very popular, but there are some clients that don't like the structure, and the main disadvantage to that is the loss of control that the surviving spouse experiences over the estate. One of the main advantages of leaving everything outright to the spouse is that they have full control over the estate, but with the FLIT, they for example have no full control over a property which they've treated as their own. The property is now owned half by them and half by the trustees of their husband's estate, of which they can be one, but it does make things a little bit more complicated. So all of these options and these pros and cons have to be gone through with the client, but with the right family, with the right client, it does work really well from both a tax point of view and a protection point of view. You may also find a different structure where you've got cohabitees. You know, to just look at the reality of the situation today, people are now choosing sometimes to cohabit and not necessarily enter into a marriage relationship. And it's important to note that a surviving cohabitee does not qualify for inheritance tax exemption in the same way as a spouse or a civil partner. And as I said before, often cohabitees can put differing amounts into a property, so a tenancy in common is appropriate. Now, in this situation where you've got two cohabitees owning a property together, let's say the value of the property here is 700, 800,000, which is quite common for the southeast of London and east of England, where Tim and I are both based. On the first death, you could easily find a situation where the first cohabitee's nil rate band of £325,000 is exceeded, and the cohabitee finds themselves subject to a tax charge that could otherwise have been avoided. Now, the easiest situation is to get married, and I've had several couples over the years that have taken my advice and gone straight away to book an appointment at the register office once they've seen me, and then emailed me a few days later to say that they are now married. But that doesn't happen with everyone. You have to get married for the right reasons. And there are some people that, for whatever reason, fundamentally don't want to get married. So in this sort of situation where you have got cohabitees, there is a structure that we can use, a structure that is available to double the tax allowances between the cohabitees and bring it up to at least 650,000. So on the death of the first cohabitee, the value of his nil rate band, which is currently £325,000, passes into a discretionary trust of which the partner and the children can be beneficiaries. When they pass away, and I'm just going through this very simply and very quickly, but when they pass away and this trust comes into existence, the value of the nil rate band is lent out to the partner and then becomes a debt of their estate that's then owed to the discretionary trust on their subsequent death. It's a liability of their estate, which when they pass away and the inheritance tax return is completed, it's a liability that then reduces the value of the estate down for tax purposes. Where the estate includes property, that loan is secured by an equitable charge on the property and can be transferred across to another property if the partner wishes to move. But we come back to the basic proviso that any value in excess of the nil rate band on the death of the first cohabitee, subject to any other exemptions, reliefs, or allowances that may apply, is still taxed at a flat rate of 40%. I wanted to briefly just cover what happens here in the UK if somebody was to pass away without having a will in place. And there are three scenarios that the legislation caters for. The first scenario is that if somebody passes away having a surviving spouse, and again, this is really important for divorcing spouses, if you don't have a will in place and you were to pass away before the absolute was granted, your surviving spouse would inherit the entirety of your estate. So that's the first scenario. The second scenario is that you have a surviving spouse, but you also have children or other lineal descendants. So if your children have, God forbid, passed away, but have left children of their own, they would then stand in the stead of your children. If you were to pass away leaving a spouse and children, the spouse receives the first slice of value to the tune of £270,000, and they receive half of the residue of the estate. The children and the lineal descendants receive the remaining half. Now, you can immediately see why this might be a problem from an inheritance tax point of view, because if the spouse is only receiving a portion of the estate and the value going to the children is above £325,000, that will be taxed at 40% because it doesn't qualify for spouse exemption. So having a will, again, is really important, because by dying without a will, and the share of assets going to your children could be subject to inheritance tax. This can be mitigated because the UK tax system does allow us to enter into what we call a deed of variation or a deed of family arrangement within 2 years of somebody's passing. What that means is that we can effectively go back and either rewrite the rules of intestacy or rewrite the will within a 2-year statutory window. So in this situation, if the children inherited a portion of the estate that was in excess of the nil rate band, they could, assuming that they were all adults and of sound mind, they could enter into a deed of variation to basically pass back whatever they've inherited to their surviving parent in order to bring the spouse exemption back into play within that 2-year window. The third situation is where there is no surviving spouse and no children, no surviving spouse. And in that situation, the beneficiaries are listed there in order of priority. So if you don't have a surviving spouse, but you have children, they will take the entirety of the estate. If you don't have children or lineal descendants, then the estate is taken by parents or the surviving parent, and then so on and so forth down that list. If you finally reach a situation where there are no family members around, then it would be the Crown bona vacantia that takes the estate. It's important to note that under intestacy, if you don't have a surviving spouse, there is no provision for cohabitees. So if you are in a cohabitee relationship, it is very important to think about making a will to make sure that that partner is protected and provided for. Just a quick point on the validity of wills, that in order for a will to be valid here in the UK, it must be made by an adult, which is somebody over the age of 18. They have to have sufficient mental capacity to understand the will and to understand the effect that it has. There must be no pressure from someone else to make the will in a particular way. A later will revokes an earlier will, and marriage here in the UK automatically revokes a will. So if somebody has made a will and then goes on to get married without updating that will, that marriage automatically revokes that will. And if they then die after that marriage without having updated their will, they are then treated as dying intestate. Divorce, interestingly enough, does not revoke a will. In the case of divorce, your former spouse is simply basically treated as being crossed out of the will. A will has to be in writing and must be signed in the presence of 2 adult independent witnesses who must also sign. All 3 parties must be present at the same time and see each other sign. And that comes from our Wills Act, which dates back to 1837. So you can see that our wills law is in dire need of updating. Beneficiaries and their spouses cannot be witnesses. And during the pandemic, the government introduced a provision to allow for remote witnessing via video conference. That only exists for a limited period and will expire on the 31st of January 2024. It is actually a real palaver to try and have a will remotely witnessed. There are lots of conditions that need to be satisfied, and I've only done it once because the situation called for it. It's not something that we do as a matter of course. In the case of foreign testators, and again, this does happen where I've got US clients with UK interests. Often I'm drafting a will here to cover their UK assets, but sending the will off to the US, to New York or Washington or wherever they may be based for them to execute it there. And I think it's just worth mentioning that under our 1963 Wills Act, as long as a will is signed in accordance with the internal law of the place where it's situated, or where the testator is resident, domiciled, or the state of which he's a national, that will is still valid under UK law.
Zahra, can I just jump in there for one
Yeah.
second? Because
Yeah.
I think you and I have done this before in any event, but what's quite important, if you do have clients that are international clients with assets in several territories around the globe, it's preferable for them to have a will in each jurisdiction.
Absolutely.
And what's absolutely really important, because we had this as a practical example, is that whoever is drafting the wills is cognizant of the other wills in other
Absolutely.
territories, so that they don't go and revoke the wills in the other territories. We had an example of a lady who had 5 wills for different jurisdictions, and the English lawyer, unfortunately, didn't pay attention to what I just said, and they opened the will as you normally do, saying, I revoke all of my wills. And guess what? That was 4 wills that got revoked. So his PI policy had to pay out for putting in place new wills in those various jurisdictions. So extremely important.
Absolutely.
And very important to make sure that each will controls assets in whichever territory, and it's clearly stated in the will. And the main reason you do that, which I'm sure Zahra will come to later, is the fact that you can then, in parallel, in each of the different jurisdictions, run the probate process, rather than having to run the probate process in the territory of wherever the person is resident, and then rerun it again in the territory where the asset is.
And that's absolutely of imperative importance. One of my very first probate cases as a trainee many years back was a lady in the US who had assets in the US, in the Bahamas, in the UK, in France, and in Hong Kong, I believe. So yes, there were several wills in place, and the administration process and the probate process ran in parallel, in conjunction. If she had just had, let's say, a US will, it would have had to be proved in the States, brought over to the UK, a similar process gone through here, and then it would have to have gone around all of the different jurisdictions. So having separate wills in jurisdictions where you've got assets does mean that the administration process is much smoother and much quicker. But again, it sort of comes back to the point that Tim and I mentioned, that if you're domiciled in the UK, all of your assets, wherever they may be in the world, will be subject to UK inheritance tax. So again, we've got to pay close attention to countries where there are, let's say, forced heirship rules that compel you to leave assets to people other than spouses, because that can, contradict UK inheritance tax law. So it is something that we have to be very mindful of when dealing with testators that have got assets in different countries.
Zahra, we have a few questions in the chat,
Yep.
so we will get to those after you finish your slides.
Yep, sure. So I just want to briefly mention the grounds on which a will can be challenged here in the UK. The first one is the obvious one, a lack of mental capacity. Often we do need to have doctor's reports to ascertain capacity, particularly where you've got an elderly or an infirm testator. Lack of knowledge and approval. A testator has got to know and approve of the contents of their will. Duress and undue influence, again, are pretty obvious ones that may mean that a will is invalid. What I want to mention, however, is a piece of legislation that was passed back in 1975, which is called the Inheritance Provision for Family Independence Act 1975. Now, I mentioned right at the very beginning that a basic principle of English law is that you have testamentary freedom. You can, in theory, leave your assets to whomsoever you wish. However, that's subject to this very important piece of legislation. So where a will or the rules of intestacy fail to make reasonable provision for certain family members and dependents who would otherwise expect to be provided for, the Act entitles them to bring a claim to redistribute the assets and to redistribute the will. The deceased has to be domiciled in England and Wales, and there are certain categories of claimant. So a surviving spouse or a civil partner is a category of claimant that can make an application under the Act for redistribution of the will if they feel that they haven't been provided for properly. A former spouse or civil partner who has not remarried can also potentially bring a claim under the Act. A cohabitee who has lived with the deceased for 2 years immediately prior to their death as husband and wife can bring a claim under the Act. A child of the deceased, a child of the family, and anyone who's being financially supported or maintained by the deceased immediately prior to their death can bring a claim against the estate. A spouse is required to be given reasonable financial provision, whether or not it's required for their maintenance. Any other category of claimant has a standard of reasonable maintenance. A former civil spouse or civil partner may be barred from making a claim under the order of their divorce. So again, when we're drafting wills for divorce clients or people who have remarried, it's really important for us to get a copy of the divorce order to make sure that any claims under the 1975 Act by a former spouse are disbarred. And when an application like this comes before the court, there are certain factors that they look at. So they look at the financial resources and the needs of the applicant and of any other beneficiary entitled to inherit under the will. They look at the size and the nature of the estate. They look at the physical or mental disability that the applicant may have. They look towards the financial obligations that the applicant has towards any beneficiaries. They'll also look at other specific criteria depending on who the applicant is. So if the applicant is a spouse, they'll look at the length and the nature of the marriage. If the applicant is a child, they will look to see the education level of the child, the age of the child, what's the child been doing since they left home. And in certain circumstances, adult children have been successful in making a claim against their parents' estate, even though they've moved out for many years ago and haven't had any financial relationship with their parents. It's not common, but it does happen on occasion. And the court has the power to make a variety of orders. And amongst them, the most common ones are the payment of a lump sum, periodical payments, transfer of property, or the creation of a settlement. And any claim under the 1975 Act has to be made within 6 months of the date of the grant of probate. So it's actually a very short time frame that an individual has to make a claim under this particular piece of legislation. One factor that the court does take into account in determining whether an applicant is successful amongst the others that I've listed is the wishes of the testator. So if there is an individual that is looking to exclude a particular category of claimant from their will, it's often advisable for them to write a contemporaneous letter of wishes alongside their will, explaining their reasons for doing so, because that holds as very strong evidence to a court as to why they don't want to particularly benefit an individual. So that is something that we do encourage our clients to do. We can help them with the drafting, but it's important to try and get as much detail as you can in that letter, so that if it ever does go before the court, they have a full picture of why you don't actually want this particular individual to benefit from your estate, despite them thinking that they are expected to receive, or despite them expecting something from your estate. Very quickly, I want to go through the process of administering an estate here in the UK. So when somebody passes away, the first things that we need to do are to deal with the practicalities. The death has to be registered with the local authority where the deceased died. The funeral has to be held, and the will has to be located, assuming that there is one. Once the will is located and the death certificate has been issued, the executors are then under an obligation to notify all of the deceased asset holders. And once they are notified, the assets of the deceased will be frozen once notification is given. The executors then have to ascertain the assets and the liabilities of the deceased as at the date of death by making inquiries with all of the various institutions, by getting valuations of property, and so on and so forth. They then have to file an inheritance tax return with HM Revenue and Customs within 12 months of the month of death. Where the estate is more complex, or where certain reliefs and exemptions are claimed, a very long form inheritance tax return that can often span to hundreds of pages needs to be submitted. I've submitted one today that went to about 92 pages in length because of all the valuations and all the information that we had to provide to the revenue to basically claim certain allowances. Where the estate is simpler, so for example, if the estate is entirely spouse exempt due to assets passing to the spouse, or if there's a charity exemption in play and the estate is under 3 million, a much shorter abbreviated inheritance tax return can be submitted, usually around 8 or 10 pages. And again, that abbreviated return can be used if the estate is within the 325,000 allowance, although that's becoming less and less common, just given the property prices here in the UK. The executors then have to look to fund any inheritance tax within 6 months of the month of death. So it's a very short time frame that the executors have within which to come up with the cash to pay the tax that's due. If the inheritance tax isn't paid within the 6-month period, interest begins to run, and the current rate is 3.5%. Now, if you remember, I mentioned that once the asset holders are notified of death, they will freeze the assets of the deceased. However, banks and building societies will release funds directly to HMRC on an application from the executors from any accounts that are held in the sole name of the deceased to pay any inheritance tax that's due. So the executors would simply send an instruction to the bank to pay X amount to HMRC in satisfaction of inheritance tax. It doesn't pass through their hands at all. The bank pays that money directly to HM Revenue and Customs. Now, funding inheritance tax can be an issue in illiquid estates, and we touched on the fact that life insurance can often be used to provide a pot of money for the executors and beneficiaries to pay for the inheritance tax. It's worth noting that the liability of inheritance tax falls on the executors to pay. However, there are certain assets, you may have an illiquid estate, and getting the cash from those assets is not going to be very easy. Under the legislation, the executors can apply for an election to pay inheritance tax on certain assets in instalments over a 10-year period. Those assets are normally property, unlisted shares, or shares that give the deceased control of 50% or more of a family company, and the value of a business. An election can be made for the inheritance tax on those assets to be paid over a 10-year period in equal instalments. Interest will be due on any unpaid tax, and if an asset is sold within that 10-year period, the outstanding IHT and interest become due immediately and payable to HMRC. So once the tax position has been settled within that 6-month period, or where an election is made to pay over a 10-year period, HMRC will then issue a receipt, or basically their approval, for the probate process to continue. And at that point, the will is sent across to the probate registry, and the executors make an application for the grant of probate where there's a will, or it's called a grant of letters of administration where there's an intestacy. Once the grant document has been received, the executors then use that document to collect in, realise the assets, and pay the liabilities of the estate. If you have an estate that comprises of property which the executors look to sell, you've got to be aware that capital gains tax may be due on the sale of the property. Capital gains tax is a tax that is charged basically on the increase in value of an asset over your period of ownership. So in the context of an estate, if a property is valued at probate for, let's say, $500,000 and sells for 550,000, that increase in value, subject to an exemption, a very small exemption of £12,300, that increase in value is taxed at a rate of 28%. Now, there are ways that we can mitigate against that. I'm not going to go into those now, but the executors just have to be aware of the basic principle that if you sell an asset above probate value, there could very well be a CGT liability that needs to be addressed and paid. In the case of property, any capital gains tax has to be paid within 60 days of completion. So again, a very short time frame within which to report and pay that tax to HMRC. The executors are then under an obligation to finalise the income tax position of the estate. The deceased income tax affairs may not have been settled prior to death. The income will potentially accrue in the estate during the administration period, depending on the nature of the assets. So the executors will have to finalise that position with HMRC as well. The estate is then distributed in accordance with the deceased's will, and the executors will apply for formal clearance from HMRC that the tax affairs of the estate have been settled. And once that clearance certificate is received, the executors can then distribute with a clear mind and heart, knowing that HMRC are not going to have any comeback on the estate. A final set of estate accounts is prepared and then distributed to the beneficiaries, and the process is then wound up. I just want
Zahra, I wonder if we should just take a quick 5-minute break. Yeah,
sure. That's absolutely
fine. I
fine.
had mentioned that before. We had a couple of questions in the chat, but how about everyone will be back at 18 past the hour, just to give you a quick break, and then we'll continue on. I know we have a little bit more for you to cover and a little bit more for Tim to cover. So we will resume at 18 minutes after.
That's fine. I'll try and answer some of these questions in the chat in the meantime.
Yeah, that'd be great. Give you a moment to take it. Thanks, everyone. See you shortly. It's really good, though. Lots of really excellent information. Thanks, Terry.
Lori, can you just, will we be able to access a copy of this deck and the questions and answers that are going on in the recording?
Yes, we will.
Excellent.
Laurie, I've just noticed a couple of typos in the slides, so I'll correct them afterwards and send you through a fresh copy to circulate.
Sounds good. No problem. Yeah. Okay. Or 18 after, so we can resume again. For those of you that had questions for Zahra, you'll find them in the chat. I think she's had an opportunity to get to those questions. And Zahra, do you want to share your screen again so we can?
Yeah, I just very quickly wanted to answer Heather's
Oh,
question.
of course,
because,
take your time.
It's going to take me a second to answer, thankfully.
Yeah.
You're absolutely right, Heather. There is a charity exemption here in the UK, an unlimited charity exemption, as well as the spouse exemption. So any gifts left to a registered UK charity are completely exempt from inheritance tax. So hopefully that answers your question. Short D3, I didn't get to yours, but I'll drop a response to that shortly.
Sure.
Yeah, Zahra, just to add on to that question about the charity, depending on how much goes to charity, it may also have the impact of lowering the overall inheritance tax rate down from 40 to 36. But you have to look very carefully at what's being given away. And there are quite complicated provisions to actually arrive at that answer. But it is possible to use charitable gifts to lower the rate on the entire estate.
Yeah, absolutely. I mean, the basic position on that is that if you were to leave 10% of your net estate, and that doesn't just mean a straightforward 10% of your net estate, it's quite a complicated formula. But if you were to leave 10% of your net estate as set out in the legislation to a UK registered charity, the rest of your estate could benefit from a lower tax rate of 36% as opposed to 40%. That's, you know, that was introduced about 10 years ago. I haven't seen a huge uptake in that in practice. I don't know if Tim has, but you know, there we are. I think, Laurie, we actually broke at an appropriate moment because I wanted to sort of switch from death to incapacity. So I think we sort of broke at the right time. So all that Tim and I were discussing at this point relates to inheritance tax, which is charged on death. Inheritance tax doesn't, of course, apply on lifetime. And hopefully, as you'll have seen, having a properly drafted will can make sure that we capture the allowances that are available to an individual and going forward a married couple to mitigate the estate against inheritance tax. But equally, when we come to look at an individual's estate plan, it's imperatively important that we think about lasting powers of attorney. We do a lot of planning around death, but we don't necessarily think about what's going to happen to our estate and how our affairs are going to be managed if we are alive but unwell. You know, often people think that powers of attorney are the domain of the elderly, and it's not something that they need to consider before they hit their 60s, 70s, 80s. You know, unfortunately, accidents can happen to any of us at any time. And I, you know, very much remember one of my first cases when I was a newly qualified, an individual who'd been in a motorcycle accident. He was about 27, 28 years old and completely paralyzed from the neck down. He'd inherited a large sum of money from his grandmother. Obviously, at that age, hadn't thought about putting in a lasting power of attorney. Why would you at 27? But again, there's a lot of money there that needed to be managed on his behalf because he lacked capacity. So I think it's just a salutary lesson that this is something that we need to be thinking about sooner rather than later. So here in the UK too.
I've got a tale on that one as well, actually, Zahra. I think you and I have shared this tale before, but it's worthwhile mentioning.
Yes.
I had a client, he had 5 buy-to-let properties in the UK and his own residence, all of which were leasehold. Now in the UK, if you have a leasehold property, there are usually service charges paid off to whoever owns the freehold to maintain the property. So if those are not paid, then it is possible that the person who owns the freehold will actually turn around and say, I want to collapse your lease and take your property back. This gentleman, unfortunately, didn't really believe in doing things with standing orders, internet banking or anything like that. And he had an extremely severe stroke and was incapacitated for a very long period of time. Now, in the UK, in order to deal with that, if you don't have a lasting power of attorney, somebody needs to apply for a deputyship. And it took the lawyer acting 9 months to get the deputyship during which time no bills were paid for this particular client of any description. So utilities weren't paid, service charges weren't paid, and he was under this estate was under threat of losing all of the properties for failure to pay the service charges. So a simple lasting power of attorney in place would have solved that problem.
Yeah, and I think we see this a lot. I will never forget, again, one of my very first cases as a newly qualified to where I was acting for a very very famous doctor on Harley Street. And he refused to put in place a lasting power of attorney on the basis of principle, despite being a medical professional, objected to the cost and refused to put one in place for himself and his wife. A few years later, sadly, the wife became incapacitated. She had an account in her name with a bank, a building society that held just under 200,000 in cash that he needed to access to pay for her care. He couldn't access that money because it wasn't her sole name. It wasn't under a joint account. He then had to apply for one of these deputyship orders, which ended up costing him 3 times as more than the power of attorney would have done, and took almost a year to get in place, despite it being a very simple application. So again, in all that time, he was footing these bills and putting himself in financial distress because he couldn't access this money. So, there are stories in practice where we do see this, and, the importance of having these documents in place cannot be underestimated. So it is a legal document, and the person that makes the LPA, the power of attorney, is called the donor, and the people whom they appoint are obviously called the attorneys. The power of attorney has to be created at a time when the donor has mental capacity, and it continues to be effective even when the donor loses their mental capacity. And the fundamental principle is, and again, going back to the will to a degree, is that it allows the donor to choose who they want to be their attorneys. If you have to apply for a deputyship order where there's no attorney, anyone, Joe Bloggs, can stand up to say, I want to be the deputy for Mr. X. That may be somebody who you don't want dealing with your affairs. So the power of attorney, again, puts you in control and allows you to choose the people that you want to manage your affairs in a situation where you can't. There are generally 2 options that you can choose where you appoint more than one attorney. You can either appoint your attorneys jointly, which means they have to take all decisions unanimously, or you can appoint them jointly and severally, which means they can act either together or independently. Now, at first blush, a joint appointment might sound better, the idea being that if you've got 2 or 3 attorneys, they've all got to agree on a course of action before they do it. But the way that the legislation is predicated is that if you have a joint appointment, such that the attorneys have to act unanimously, and if one attorney is, let's say, out of the country, incapacitated, or has just died and can't act, the entire appointment fails because the document names 3 people that are supposed to act jointly. If they can't act jointly, they can't act at all. So it's actually quite restrictive to have just a joint appointment, which is why our recommendation and our advice tends to be to appoint your attorneys jointly and severally so they can act either together or independently. So if one attorney was to die or become bankrupt or become incapacitated, the other attorneys could continue in their role seamlessly and still look after the person that needed to be looked after. It doesn't, come without its problems, a joint and several appointment, but it is much more flexible. And I think the key here, when you're looking at wills, when you're looking at LPAs, the key here is that we don't know what's going to happen tomorrow. So having a structure that is flexible, that can cater for a variety of scenarios, is probably more beneficial than actually being quite rigid and quite prescriptive over these things. There are 2 powers of attorney that we can have here in the UK. One is for financial decisions, and one is for health and care decisions. At the time that the power of attorney is signed by the donor, it has to be certified by a certificate provider, who is usually a solicitor, a lawyer, or a GP, being the donor's doctor. The power of attorney then has to be registered with a UK government body called the Office of the Public Guardian. It's only when the document is registered with the OPG that it can be effective and therefore used going forward. So just to very briefly cover the sorts of things that a financial power of attorney would deal with. So it allows the attorneys to deal with the sale of the home or any other properties, to manage investments, to deal with stocks and shares, simple things such as writing checks to pay bills, setting up standing orders, direct debits, operating bank accounts, claiming and receiving any welfare benefits, dealing with tax returns. The attorneys can also make small gifts on occasions such as Christmas or birthdays, but larger gifts and tax planning requires the sanction of the Court of Protection. So if you have an individual that has lost capacity, that has got a large estate, and the attorneys think, oh, it would be beneficial to do some gifting to reduce the value of the estate in the hope that this person survives 7 years, that's not permitted without the sanction of the court. And I will never forget a very sad case that I had was an elderly lady who was from the US who had a significant amount of money here in the UK once her property was sold, but she had lost capacity. And her daughters, her 3 daughters, were appointed as her attorneys under the terms of her power of attorney. The property had been sold, a large amount of cash was sitting in her bank account. I think it was somewhere in the region of about £1.5 to £2 million. And the daughters thought that it would be a good idea to make themselves gifts of that money in the hope that mother would survive at least 3 years so that the taper relief would kick in, so the inheritance tax on that estate wouldn't be as large as it would otherwise be. However, because they were operating under a power of attorney, they couldn't make that gift under the terms of the power of attorney, and we had to make an application to the Court of Protection. That application was quite rightly a detailed application. We had to explain to the court why it was in the best interest of the individual and so on and so forth. After preparing a very comprehensive application, we sent it through to the court and it was approved. I certainly wasn't expecting it to be approved, but it was approved. But she died the day after the order came through. So unfortunately, that gift couldn't go through. But it's just an example that anything larger, anything more than preserving the estate of the donor generally requires the sanction of the Court of Protection. The sorts of things that a health power of attorney can cover include things like deciding where the donor should live, the type of care they receive, who they live with, their activities. But most importantly, it deals with life-sustaining treatment. Life-sustaining treatment is defined in the legislation as anything that is required to keep a donor alive. So it could be life support, ventilation, heart surgery, cancer treatment, artificial hydration, nutrition, anything that is required to keep an individual alive. If they do not have the ability to make that decision themselves, they can, in the power of attorney, decide who makes that decision for them. They can say that my attorneys have the right to say yes or no to life-sustaining treatment, or they can say, I don't want my attorneys to have that power and I want to leave that power with my medical team and my doctors. So if, this is the reason why most people tend to put these powers of attorney in place, because they have got very strong feelings about who should be making those end-of-life decisions for them. A lot of people come to me and say, what do most people go for? Do they go for the attorneys making that sort of decision, or do they go for the doctors making that sort of decision? And the answer is there is no right answer. It just depends on your personal preference. There are many clients that I have who want their families to be able to make those end-of-life decisions. Equally, I have many clients coming to me saying that it's a very hard and a heavy decision for my family to live with, so I'd rather the doctors made that decision. Whichever option the donor goes for, it is expected that there will be communication between the medical team and the family, but ultimately this comes down to who makes that final decision. And this is the reason why a lot of people tend to go for these powers of attorney, because it does give them some flexibility and allows them to make a choice as to who makes those very important decisions on their behalf. Just as Tim and I sort of alluded to, that if you don't have a power of attorney, the only alternative, if your affairs need to be managed on your behalf, is to apply for a deputyship order. Deputyship orders are generally only issued by the court for property and financial affairs. They are very rarely issued for health and care decisions. There is no guarantee that the person who stands up to be appointed as a deputy would be the same person as you would have chosen as your attorney. So again, your control is taken away from that process. Part of the application, and one of the reasons why it takes so long to put that application together, is full financial disclosure is required by the court of the donor's affairs and the deputy's affairs. The deputy is subject to background checks, credit checks, to make sure that they are an individual of sound standing, capable of dealing with somebody else's affairs. The idea being that if you can't deal with your own financial affairs, how can you deal with somebody else's? So the court does require full financial disclosure of both parties. It is therefore a lengthy and time-consuming application. The last one that I did took about 15 months to get through the Court of Protection, despite it being a very simple, straightforward application. In comparison, a lasting power of attorney registration, it has been taking longer throughout the pandemic. waiting times have gone up to about 24 weeks, but they are starting to come back down. Pre-pandemic, you were looking at a registration time of 12 weeks, which is 3 months. So by comparison, that is a much quicker way of making sure that your affairs are in order and that you've got the right people in place should something happen. A deputyship order, again, just by virtue of the nature of the application being much more lengthy and paper heavy, is more costly. And the deputy is subject to ongoing supervision and monitoring by the Court of Protection. Spot checks are carried out. There's an annual duty to account to the court that an attorney under a lasting power of attorney doesn't have to do unless the donor actually stipulates in the document itself that they want their attorney to make an account to the Court of Protection every year, whereas for a deputy, it's something that they just have to do. And I think that's kind of where I wanted to leave it. And I know Tim has a piece on IHT and UK residential property, so I will stop there and hand over back to him.
Great, thank you, Zahra. A couple more questions in the chat, if you have a moment. And yeah, Tim has a wrap up now that we learned all those things. I think he has some more information to share with us.
Right, so yes, we're going to talk about some strange things which might sound extremely weird when we go through this, but it just picks up on what's important in relation to the complexities tied up with inheritance tax. Now, I've just got to move my slide deck forward a bit. Sorry about that. And we'll get to, here we go. Right, so what we're going to look at here is UK residential property. Now, HMRC or the government are absolutely hell-bent on collecting tax on UK residential property in terms of inheritance tax, and they have altered the rules very, very considerably over the last few years to ensure that they achieve that. So we're going to look at 4 different scenarios here where the UK residential property is either owned personally, inside a company, inside a trust, or where somebody has had loans to buy the properties, and look at the different scenarios and the different tax charges. So if we take the first instance, personally owned property, let's say the property is worth £5 million. Let's say there's a loan secured on the property for £2 million. So the net value of that property is £3 million. There is a nil rate band that applies, as we discussed earlier, of £325,000. And the exposure, if this is not being inherited by a spouse, is on £2,675,000 at 40%. If the estate had have been less than 2,350,000, there is actually an additional relief available in terms of the residence nil rate band. Now let's look at what happens when the asset is owned inside a company. Now, here we're going to look at, say, a £10 million property. There are other assets inside the company, in my example, of £90 million. So the value of the company is £100 million. There's a loan, 90% against the value of the residential property, so £9 million. So the net value of the company is £91 million. Now, what happens here is that the tax is actually worked out by not deducting the full amount of the loan secured on the property, but it turns around and says, what is the value of the residential property compared with the total value in the company? So in this case, 10 million over 100 million, and that is multiplied by the amount of the loan, and that therefore the only deductible element of the loan for the purposes of inheritance tax is 900,000, and therefore inheritance tax is payable on 9.1 million in this example. So this is a really unfortunate scenario where you would have thought that the amount of inheritance tax would only be on £1 million, i.e. the value of the residential property less the loan secured on the residential property. But unfortunately, these rules were introduced which changed the amount of deductibility of the loan. So extremely important, and therefore structuring of any vehicles of this nature is very, very crucial to ensure that you actually obtain the result that you want to obtain. If we use a trust instead, you've got a residential property there worth 10 million. You've got a nil rate band of 325,000, and this is putting into the trust, by the way. And then you have got a tax charge, what's called a lifetime tax charge of 20%, which is £1.9 million. And if the property is in there for a particular period of time, because everything is dealt with in 10-year stretches, the theory behind that, by the way, is it's all to do with what's called a generation. A generation is supposed to be 30 years, and the government paper at the time said that they wanted to collect inheritance tax over a generation. So they said, what we'll do is we'll make a charge every 10 years, i.e. a third of a generation, and therefore we would charge tax at 30% of any normal tax that applies. So these trusts have charges every 10 years, and they have charges when things come out of trusts. So in this instance, where the properties come out of a trust, there is a charge which is based upon the number of complete years or complete quarters. It's actually broken up into 40 quarters. I did it as 3/10 there, but that would actually be properly expressed as 12/40ths. And that's how you would arrive at the tax on assets inside a trust. Now, this one is a very strange one, so I'm going to flow the diagram and then we'll talk about it afterwards. But it will show what happens where you have got loans and offshore companies, etc., going on to buy a UK property. So there's the client. There's the house the client wants to buy. The client might settle a trust offshore to the UK. They might also create a offshore company, which is owned 100% by the client. And there is a £500,000 deposit placed on the house. So you've therefore got a 95% loan going to come in a minute. There's the bank. And the bank is going to require the offshore trust to pledge £15 million worth of assets so that it will lend £9.5 million to the offshore company, and the offshore company will buy the property. That's historically a very common structure in the UK. Now let's see what the consequences of that structure is. The deposit is going in from the client, so that gives you 10 million to buy the house. Now let's deal with what's going on here. So the shares in the company, which value is derived from the residential property, is £10 million. There's a loan of £9.5 million. So the element of the shares that is taxable to inheritance tax is £500,000. That probably makes logical sense to most people based on what we've said earlier. Now this is a bit that's very illogical. The loan of £9.5 million is being guaranteed by the trust, and the bank has required the trust to guarantee that £9.5 million using £15 million of its assets. What the law says as a result of that is that you bring into the charge to inheritance tax the amount of the assets that have been used for the guarantee, i.e. 15 million. So you're going to end up being charged to inheritance tax on £15.5 million, actually more than the value of the UK house. So again, extremely important to get your structuring correct. Otherwise, you could actually end up having a charge to inheritance tax greater than the value of the property concerned. Questions. Now, I know there's been some questions in the chat. Laurie, do you want to pose any questions to us so we can answer them verbally?
Let's see.
Yeah, hopefully I've hopefully answered most of the questions in the chat whilst Tim was talking, but if there are any more, then do let us know.
The property taxes that Tim just covered, are there any questions regarding those?
I have to say the rules on particularly residential property have become extremely complicated. And in fact, I have a situation going on at the moment, which the trustees aren't really looking forward to because they don't believe they got to charge, but it's a Jersey-based trust, so a trust outside of the UK, and they don't actually own any UK assets. The problem is they've lent money to a UK-based beneficiary, and that UK-based beneficiary has used that money in relation to UK residential property. It causes that loan to be considered as a UK asset and liable to inheritance tax in the hands of the trust. Now, as some of those diagrams earlier mentioned, the issue then comes that the trust has to disclose all of its assets to HMRC, the onshore ones in the UK, which is only the loan, and all the offshore ones as well. And inheritance tax is actually worked out on the total value of the trust and then apportioned between the UK asset, being the loan, and the non-UK assets. At the moment, the charge is coming out at something like £1,000 of tax. The fees to work it out, on the other hand, are coming out at something like £6,000 or £7,000.
Wow, that's a lot. That's crazy. Okay, we just got a question here from Tanya.
Yeah, Tanya, I'm not sure I understand your question. To describe what the IHT consists of. So the inheritance tax charged is charged on the value of the UK asset. So that could be UK property, UK cash, whatever is in the UK would be subject to inheritance tax for a non-UK domiciled individual, to the extent that that value is above £325,000. If that individual had a spouse and they had a UK will, by which they left assets to their spouse, at that point, there would be no tax to pay on the first death, and on the second death, the double spousal allowance would kick in because of the way the transfer rules work. I don't know if that answers your question, but feel free to let me know if not.
Yeah, if you want to, you can take yourself off mute, Tanya.
Just as a matter of interest, by the way, we do have an interesting concept that was introduced a few years ago to help deal with mixed domiciled marriages, where we mentioned earlier there is a restriction on the amount of the relief available between mixed domicile spouses. So there are occasions where you might have a one of the spouses is domiciled in the UK, and maybe the other spouse is domiciled elsewhere, let's say the US as an example. And if the UK domicile spouse dies, leaving assets in the UK, and they leave them to the US spouse, there would be a restriction on the amount that is subject to tax at 0%. It's now possible to make an election by the US domiciled spouse to be considered for the purposes of UK inheritance tax as domiciled in the UK. That would mean that they would then get full spouse exemption for those assets of the UK domiciled spouse that they are receiving. Now that sounds like a lovely, lovely way of dealing with a problem in the UK, but they do need to fully understand the implications of making that election, because you then become domiciled in the UK for inheritance tax purposes, which would drag your assets outside of the UK into the charge to inheritance tax should you pass away before you've managed to shed that domicile again, which you can do, by the way, by being not resident in the UK for a period of years. So it's a short fix, great answer, but you have to take very considered advice as to what you're doing before you go ahead and do it.
There's also another slight peculiarity that exists in relation to that situation where you've got mixed domicile couples, which I've come across before, where you've got assets moving from a UK domiciled spouse to a non-UK domiciled spouse. That's where the 325 restriction applies, and the spouse exemption isn't unlimited. But if assets go the other way from a non-dom spouse to a domiciled spouse, then it is an unlimited exemption, and that's a peculiarity that I came across in one of my files not so long ago. And in this case, the husband refused to make a domicile election because he didn't want to be treated as being domiciled in the UK for that period of time. So he just basically said, my kids will have to pay whatever tax they have to pay. And that was it.
Wow.
Very common, unfortunately.
Yes.
Interesting. Okay. One question here from Alistair. Can an individual who has a UK domicile of origin but severed that such that they have a domicile of choice that has taken them outside of the inheritance tax, can that person make the deemed domicile election if they have a spouse who dies with a UK domicile?
Yeah, well, they can make the election. Having said that, the HMRC got a bit funny about people who were what they call formally domiciled. So they call them FDRs. It's a formally domiciled resident. So somebody who was originally UK domiciled, they then went away, made a domicile of choice somewhere else. If they return to the UK, they actually become immediately domiciled in the UK from the day they return. There's actually, I think, a 12-month holiday in case they came here by accident. But if they didn't come here by accident, then they will immediately drop back into the UK inheritance tax net on their worldwide assets. But yes, they could, if they were not resident and therefore not having their domicile origin re-emerging, they could actually, in theory, make that election without any issue.
Great, thank you. Thank you, Tim. Okay, one question here from David, and then I think we'll wrap up. What happens when someone with a UK pension moves to Canada? Are they taxed in the UK first and then claim a tax credit on their Canadian tax return? Are they able to transfer the pension to Canadian pension plan?
Well, this depends really on what you want to get up to here. This is moving off of the topic a bit, but totally. So what you can do, you can do a number of things. So first of all, under the double tax treaty between Canada and the UK, if it follows the normally OECD ones, it would allow the person to only pay tax on their pension in Canada or not pay tax on their pension in the UK. They need to make an application to HMRC for that. This is income tax, by the way, for that to happen. And once that has been accepted by HMRC, the pension provider will pay the pension without any deduction of UK tax. They will then pay tax on it in Canada accordingly. Where you have to be careful, HMRC, I think, have taken a stronger line than a number of other jurisdictions. But if a double tax treaty says you can do something and you don't do it, HMRC certainly turn around and say, tough, you should have done it. So if you didn't make the claim for the exemption from UK tax, then Canada may or may not give you a credit for the tax paid in the UK. And by the way, pension funds are normally outside the scope of inheritance tax. You do have to be careful. You have to do something called a letter of wish to the trustees of the pension scheme, indicating to whom you might ask them to make payment of the funds from the pension fund, because in the absence of that, if the pension fund is then paid out on someone's death, it will re-enter their estate and then be liable to inheritance tax. So a simple letter of wish, as it's called, to the trustees of the pension scheme will avoid that problem. The final thing somebody could do, it's messy and it's expensive, so be very careful before you enter into it. You can transfer a UK pension into something called a QROP, which is a qualifying overseas pension fund. They're very expensive. There was a whole hoo-ha with financial advisors charging vast amounts of money for it in the UK, but it is a way of taking a UK pension out of the UK net altogether and moving it to another jurisdiction. Often people were using places like Malta as an example because they have different rules there, which are slightly more advantageous.
Right. Wow, that's great. Okay, I think we're coming up to our time, so I'll just quickly close the meeting, and if anyone has a further question, you can stay on, but I'll let everyone else go who have been with us for the last 2 hours. Thank you so much for attending, and feel free to reach out to our presenters, Tim and Zahra. We will be including their contact information. We will distribute the slides and recording shortly, and I invite you to become part of our estate planning community. I will send out that post-meeting follow-up later. Have a great day. Bye, everyone. Thank you, Tim,
everyone.
Thank you.
Thank you, everyone, for your time.
Lots of great comments.
Great presentation.
Thank you.
Chock full. Perfect. So we'll just see if there's any last questions.
Laurie, I'll just tidy up those slides and send those to you in the next few minutes.
Sounds good. Thank you, Zahra. Okay. Don't see any other questions coming in, so I think we're good to go. Yeah. Yeah, we're all clearing off. All right. Thanks, Tim. That was so good. So clear. Zahra, you covered tons of material. So I
was worried it might be a bit too much, but
we were
it
right.
should hopefully give people food for thought in the nicest way.
Oh, yes.
Tim and I have worked on a few interesting clients, haven't we, Tim?
Yep. Just a few.
Oh my goodness.
And they have sometimes they have thoughts in their head which are so far off the mark, it's unreal, and you just have to kind of bring them back to reality to show what's going on. I'm actually working on a client with one of Zahra's colleagues at the moment, which is that one about making the domicile election. And it's proving interesting because unfortunately her grasp of English is not great. So she brings a friend with her. She's Chinese. She brings a friend with her who acts as a bit of an interpreter. But because you're never actually sure what the conversation is that's going on between them, you're never really sure how what you're saying is actually being put across. But it's interesting. Let me put it to you like that. It's certainly interesting.
I should say. Well, this is good. Wow. Thank you. Thank you so much. So yeah, Zahra, I'll wait for those slides, and I'll make sure everyone has your contact information, and this was great.
All righty.
Brilliant. Pleasure. More than happy to help.
Well, have a good evening.
Take care, everyone.
Bye now.
Cheers then. Bye.